Welcome everyone to Understanding Financial Ratios. We have Ramesh Advani. He's from SCORE Boston Mentor, and he's going to give our presentation today. We also have two representatives from Middlesex Savings Bank. They sponsored this presentation today and feel that it's an important topic for their clients as well as SCORE clients. So we're very happy to have them both here today. But we're going to go ahead and introduce you to SCORE first as we get started. We want to make sure that you're taking advantage of all the resources that we offer. Our main goal is to share small business information. We do that in a couple different ways. One is through our website, score.org. There's templates you can download, financial reports, for example, business plans, marketing plans. There's articles, blogs. We actually just introduced our new podcast. We're going to be adding podcasts every couple of weeks. The other way we share information is through our workshops and webinars, and we have a nice offering for this fall through the end of the year. So definitely take a look at those. We advertise those through our newsletter, website, and on social media. The most important thing the SCORE does, however, I think, is the mentoring. And our mentors are volunteers, and they have a wide variety of experiences and backgrounds and want to give back to the small business community. They want to help you be successful. And we work with folks at all stages of the game. Those that are trying to decide if small business is right for them, those are in that planning phase, and those that are already in business. And actually, I could probably add a fourth, those are getting ready to sell or exit their business as well. So we will help folks at all stages. If you've never met with a mentor before, the beginning session is going to be learning about your goals and your challenges, and your mentor will work with you to come up with a plan to be successful. Often they will invite other mentors as your needs change and progress, and you'll have a small team that's going to help you do what you need to do to achieve your goals. Getting a mentor is very easy. The easiest, there's actually several ways on the website you can get a mentor, but probably the easiest is score.org. And if you scroll down, there's going to be a blue box under the mentoring page that you can type in your zip code, and that'll match you to the chapter that's nearest you. There's a questionnaire. It's very short. They just, getting a little information on what kind of help and assistance that you need, and also what your business is, so that we can match you to the mentor that most closely fits what you're looking for. So we do have a lot of people on the call today. So we definitely are going to use that Q&A button. If you could put questions to the presenter or even to the bank into Q&A, we will get to the questions as we can. We are recording, and the recording will be posted at score.org/Boston. Under local workshops tab on the blue bar, there's a previously recorded option, and it'll be listed there in probably 24 to 48 hours. So I want to go ahead and welcome our sponsors today, Middlesex Savings Bank. We have David Bennett and Jeff Homileski here today with us. Jeff is going to introduce us to Middlesex Savings Bank and the offerings that they have for commercial banking. Jeff?
Thank you, Teresa and Ramesh and SCORE for having us here today. Looking forward to the presentation. Middlesex Savings Bank is a mutual bank, 189 years old, headquartered in Natick. We service all of Eastern and Central Mass, certainly a focus in Metro West and Worcester counties. Dave Bennett, head of business banking, on the line today, and his team of lenders work with a variety of clients on financing solutions, and oftentimes serve as not only a client's banker, but very often their advisor, and offering advice on a variety of financial topics and lending needs. So I encourage you to chat with Dave or other folks on his team if needs arise. So again, we're looking forward to today's presentation, and very interested to hear Mr. Ramesh's discussion.
Okay. Ramesh, it's all yours.
Okay, thank you, Teresa. Welcome, everybody. Let me just share my screen here. Can everybody see my screen?
Looks great.
Okay. So just so that you know, this, besides it's being recorded, these slides are going to be available to you, if you provide your information or say you want them. Teresa will send them to you. It's not a complicated or a very long presentation. There's plenty of time to ask questions and go through that. And so let me get started. I will start with introducing you to what are ratios, and then we're going to talk of different types of ratios. And in the financial world, available for the business owner, or for your if you're a large organization, you have your CFO and your or accountant. There are many kinds of ratios. I am just going to speak about what we think of as the most significant ratios that you should be familiar with without having to go to some bean counter or to anybody else to calculate those for you. So we're going to talk about liquidity ratios, operating ratios, profitability ratios, and working capital ratios. And I'm sure the first question already comes up, well, which of these is the most important? I don't have a time to look at lots of things. Well, I'm just going to go over one or two ratios in each of these categories. There are lots and lots more also, but we are not going to get into all of that. So let me start with what are financial ratios. So right at the start, I want to make sure everyone knows that a financial ratio is almost like if you were driving down on the highway and you saw a sign for an exit. It's simply an indicator telling you something. It's not telling you every little detail about your business. Now, why is it important to look at that? Because if you are having problems or any issues with your business, one way of getting, how should I put it, like an early look at, ooh, I should look into this area or I should look into that area. You do that by looking at some of these ratios, because that kind of starts to tell you when the ratio is behaving in a certain way. It says, I better look into that, or I better talk to my operations person, or I better talk to my marketing person, or whoever, or even talk to yourself, what you may have to do as an entrepreneur, or to talk to your banker. So it's very important to get a way of an early warning signal, and that's what financial ratios do for you. The other thing is there aren't complicated documents that you need to go into to calculate ratios. There are two documents, and I'm sure you as a business owner have heard of them. One is your profit and loss statement, your P&L, and the other is your balance sheet. So you should be able to pull up your balance sheet and your profit and loss statement at any time. If you don't know how to get that, you should have your whoever does your bookkeeping or your CFO to bring that and provide that to you. And I will make a big assumption here that you have looked at these before, but then you look at it and say, okay, now what am I looking at? I should calculate out some ratios, and you use those documents. Now, a balance sheet, most businesses will print out a balance sheet either when your banker or somebody asks you for it, or you will most likely get a quarterly balance sheet at the end of a quarter and at the end of a year. A profit and loss statement you could get at any frequency. So you have monthly profit and loss statements. You have year-to-date profit and loss statements once a quarter, or you have them also for the whole year. To keep it simple for our conversations, let's just say we're talking about a balance sheet at the end of a given year and a profit and loss statement for that year, okay? The last thing you should think about is what time frame should you use? There is no one answer to that. You can look at things at a frequency that you want, quarterly, annually. Sometimes the most important message you can get is from trends of numbers. So when you're looking at a trend, you should look at your ratios, say, on an annual basis. Or you look at it, let's say, how was last year through the third quarter versus what I'm doing this year through the third quarter. So there is no one set answer. It's more to get you familiar with how you're going to do this. I would suggest you do that. Later on, I will also tell you that if you want to talk about looking at your ratios for your business, we can always set up a free mentoring counseling session, and I can meet with you, and then we can look at your financial statement that you bring to the meeting, and then we can look at it and see, which ones are things you may want to probe further into. So I will pause, and I'm going to do this with each of my slides. Are there any questions that come to mind based on what I've told you overall about financial ratios?
There are no questions currently.
Great. So we're going to talk about 4 types of ratios. I'm going to start with liquidity ratios. What are liquidity ratios? Liquidity ratios basically help you understand, can you meet your short-term obligations using cash or cash-like assets? What is a cash-like asset? It's, for example, you might have accounts receivables. Those are cash-like assets. You have marketable securities that are owned by your business, stock that you could sell them. So liquidity helps you understand how quickly you can meet any short-term obligations. What do I mean by short-term? I mean anything that you have to pay somebody in less than a 12-month window, 3 months, 30 days, 90 days, whatever. So liquidity ratios help you understand that. And why do you need to understand that? Because if you don't pay the obligation, you may have to declare bankruptcy or go into default. And if you stay on top of your liquidity ratios, you will avoid those situations. You should also know that analysts, creditors, and bankers look at these liquidity ratios. So I'm going to only talk about 2 liquidity ratios: current ratio and a quick test ratio. Quick test ratio is also called an acid test ratio. So what is a current ratio? A current ratio is calculated by looking at numbers on your balance sheet. On your balance sheet, you have assets and liabilities, and your assets are either current assets or long-term assets, and your liabilities are current liabilities or long-term liabilities. A current asset or a current liability refers to anything whose life is less than 12 months in your current financial year. So your current ratio is simply calculated by taking your current assets from your balance sheet and dividing it by current liabilities. And you should try to make sure that your current ratio is greater than 1.5 or 2, because that says things are fine in terms of your liquidity. If it is less than 1, it means your liabilities are exceeding your assets, and current liabilities, current assets. And that means that you're not solvent, that you are probably going to go into default or bankruptcy because you have to pay off those liabilities. That's what the current ratio is. Now, the other liquidity ratio is a quick test ratio. And that is calculated also from your balance sheet. And on your balance sheet, you look at your current assets and you minus the value of inventories which are on your balance sheet and divide it by the current liabilities. So in your current assets, there are three major categories of assets. There's cash, there is accounts receivable, and there is inventories. Now, why do we do this calculation of a quick test? Because if, let's say, your current ratio looks great, but your quick test ratio is less than 1, what does that mean? In the number of your current assets, you've got inventories. Inventories are not something that you can liquidate instantly. Cash, for example, if you have to pay off a liability, you owe money to somebody and you have to pay somebody in 30 days, you've got cash in the bank, you can take the cash and pay it. When you look at your quick test ratio and leave out the inventories, which may be harder to liquidate, that's why we have this term called quick test ratio. So you should make sure that you understand what your quick test ratio is and what your current ratio is. Any questions on liquidity ratios?
Is there a set point where it is not possible? Whoops, hold on, sorry, it's in chat that scrolled on me. Give me a second.
Is it what?
Oh, it scrolled on me just a second. It was in the chat, not the Q&A. So is there a set point where it is not it is not possible to reverse insolvency? I am trying to determine if my business can be saved or if it is time for me to dissolve the business. Okay, I'm sorry. We'll have to address that one probably a little bit more offline, but if you wanted to.
Yeah, sure. Yeah, so if you're going to file for bankruptcy, if you file Chapter 11 or things like that, that's another whole process. You'll have to look through your, who your creditors are, and there are different people you owe money to, which in certain sequence there are subordinate creditors to other creditors who have priority to get, and then how do you liquidate things? I mean, that's another whole conversation which we should have, as opposed to what I think of as we're talking about looking at your financial ratios for an ongoing business.
If your current or quick ratios are both under 1, is bankruptcy inevitable?
It's not inevitable. Nothing is inevitable. I should say that, but watch what I say. But I would say what you have to do is start to think about looking at what the indicators are telling you and what action you need to take. Again, that should be something that we should probably discuss in a more in-depth manner. But if you ignore it and it continues to be that way, then yes, it is inevitable. Also, let's say you do a calculation of your current ratio and it is, I'm making it up, let's say it's 0.7. So you should look at what your current ratio was at another point in time, maybe 12 months ago or even 6 months ago. And let's say at that time, your current ratio was 1.2, but now it's gone to 0.7. Whoa, it's going in the wrong direction. That's when you start to wonder. So you have to look at trends on some of these things. In a more generic way, that's the answer that I would give you right now,
Is there certain things you should look at to correct if your quick test is less than 1?
Yes, you should look at the numbers that make up your current assets, your cash, your accounts receivable, your inventories, and you should look at your liabilities, your accounts payable, your payroll liabilities, or any short-term loans that you have. Each of those will require different types of action. So for example, if your accounts receivables are not getting converted into cash fast enough, then you have to look at what terms you're offering, payment terms to your clients. If you're looking at your liabilities, if your payables are very high, then you need to figure out how to bring those down. So I couldn't give you one set answer. It all depends.
And if you're looking at liabilities for the coming year, would you also take into account projected revenues over the same period?
What do you mean if you're looking at liability? You mean like if you've got some loans that are coming due in the coming year?
He says that they're a service-based business and get paid in short proximity to the provision of the services.
I see. Yes, I would assume that as part of your financial management, you are doing some planning, i.e. budgeting, which means you're really forecasting what you want to do in the coming year. So yes, you should be looking at that.
And what is the standard time frame associated with for liquidity requirements?
You should you should try to be liquid all the time. I'm sorry to make it so direct, but if your current assets are at least 1.5, I think that says you've got enough cash that is coming in from your operations and you're able to use it. And then that also helps in your using of your assets for investment, expanding your business and for growth.
That's all we have for now.
Okay. All right, so that's liquidity ratios, current ratio and quick test ratio. The next category is operating ratios. And in operating ratios, again, there are many, many operating indicators you can look at. I'm just going to talk about two. One is your operating profit percent ratio. In other words, how much profit are you making? What's the margin? Are you making 10% margin, 20% margin, 40% margin? And how do you calculate the profit percent ratio? This is a number that you calculate by looking at your profit and loss statement. And the calculation is taking your sales dollars or your revenue dollars that result in profit. And when I say profit, on your profit and loss statement, there is a line profit before taxes or miscellaneous income. That's the profit number you should look at. So you take your profit and you take your sales dollars and see what percent of your sales dollars are being converted to profit. So for every dollar of sale, am I getting 25 cents profit? Am I getting 40 cents profit? So that's, 25 cents on a dollar would be 25% profit, operating profit percent ratio. Now, why should you look at that? Because if you are not making enough of a profit, there are two areas that you could address. Look at your pricing strategies. So this is looking at how you're dealing with your products and services in the marketplace. The other is look at your costs. Your costs may be very high, and so you may have to consider some cost reduction strategies. You can this is not going to tell you what action to take. That is a function of your business operations, but it can tell you where to look. The second operating ratio is something called inventory turnover ratio. And the way you calculate the inventory turn ratio, you use two different numbers. One is you look at your profit and loss statement and you look at your annual cost of goods. So the cost of the goods that you're selling. And if you take your inventory dollars and it's divided by your annual cost of goods. That gives you the inventory turn ratio. Now, there's a very key little word at the start of that bullet in that definition, average inventory. What does that mean? So you should calculate your inventory turnover ratio, let's say on an annual basis. You get the inventory dollars number from your balance sheet. So this is a ratio where you're looking at not just your profit and loss statement, but your balance sheet. And what is average inventory? A balance sheet, as all of you may know, is a document that's produced at a point in time. So if I'm looking at a balance sheet as of December 31st, 2024, and I'm looking at the balance sheet as of January 1st, 2024, and I look at the inventory number on both of those, I take an average of that. That's what you would use in this inventory turnover ratio. And when you calculate that number, this ratio tells you how often in a year your inventory gets depleted or needs replenishment. And why is that important? If you say you have inventory turns happening 4 times a year, every 3 months, you're depleting your inventory. And if that is how you run the business and how it runs in your industry, and it might be good, but if let's say your inventory turns ratio is 12, it's getting depleted very fast. That means you have too high a turnover. And if the competition is able to have a turnover ratio which is less than yours, that says that, wait a minute, you may not be making things fast enough, and there's a demand there for your product or your service, and you might be missing sales opportunities. So this third point that I'm making under inventory turns ratio, it again tells you, it doesn't tell you what the inventory ratio should be, but it tells you where you should go look and what action you need to take. Because missing sales opportunity is not good, and having too much inventory is also not good. How you run your operations to put your product into, finished goods into your warehouse or provide it to your distributors. Many different operational questions will come to the forefront when you look at your inventory turn ratio. So the two operating ratio numbers, one is the profit percent, operating profit percent ratio, and the other is the inventory turnover ratio. Any questions on that?
Yes, can you repeat the calculation for the operating profit ratio, please?
Yes, as you look at the profit, which is on your profit and loss statement, it'll say net operating profit, and below that you'll have taxes, etc. So you take the net operating profit, and then you take your sales dollars, which is the top line, the revenue line, and divide the profit by the sales dollars, and convert it into a percentage, and that's your operating profit percent ratio.
Does the operating profit ratio also factor out depreciation or amortization?
Depreciation or amortization will be there in the cost area, which is above the profit. So the answer is yes. It factors in, because as you may know, depreciation or amortization is really taking your capital investment that you made in your fixed assets, and you're spreading out that cost over your profit, over your profit and loss, over your operations. So yes, that is a cost. It's not a cash related cost, but it is a cost.
How does the inventory turnover ratio apply to a service-based industry?
It doesn't. If you're selling services and you don't have any physical product or goods. It only applies if you're selling physical product, merchandise or manufacturing product, that's when it applies. Otherwise, it's not a relevant ratio for you.
That's it.
Okay. So liquidity ratios, figuring out how much cash you have and how well are you managing your cash. And operating ratios are how well are you managing your operations. Then the third one is profitability ratios. Now, profitability ratios are more than operating profit percent. These are ratios that if somebody asks you, so what's the profit in your business? Somebody wants to invest in your business and they say, how do I know how much I'm going to get back? And what's your profit margin? So the first one is something called the gross profit margin. And this number is calculated by looking at your profit and loss statement, your P&L. So you take your net sales minus your cost of goods sold, which is always shown on your profit and loss statement just below your net sales, and you divide that by your total revenue. And that gives you your GPM, your gross profit margin. Now, what should you be thinking about when you look at a number for your gross profit margin? Because none of this is an absolute. Everything is all relative. As far as your gross profit margin, it should be either stable or it should be increasing over time, not declining. If it's declining, it says you're sort of going out of business. The next profitability ratio, which sort of dives a little deeper into your profit and loss statement, these are also numbers that you get from your profit and loss, the calculations you get from profit and loss statement. So the net profit margin, which is the NPM, it equals taking your earnings after taxes. Now, when I told you on top, it was the gross profit margin, the net sales minus cost of goods sold, that gives you the gross profit. But on that gross profit, you have to pay taxes. So when on your P&L, if you look at your earnings after taxes and you divide that by the same number, total revenue, that gives you the net profit margin. So you could have, I'm making this up, gross profit margin of 50%, and then you pay 50% taxes on that. So your net profit margin would be 25%. If your net profit margin is declining year over year, or what your industry or your competition is making by way of net profit margin, then you need to take this ratio and go back and look at your costs, look at your management effectiveness. You may have too much overhead in your business. You may need to cut out some of those costs and introduce some cost reduction plans. That's what the net profit margin helps direct you as to where you should go. The last profitability ratio that I will mention is something called return on assets. So if if you want to raise capital and you want somebody to invest in your business, people want to know what your ROA is. And basically, an ROA is exactly what it says. It measures how much profit is generated from each asset dollar that is invested in your business. So if somebody says, I'm going to invest $1 million, what am I going to get on an annual basis and for how long? That's the return on assets. How do you calculate it? This is a calculation, just like we did the inventory turns ratio. You have to take numbers from the P&L and your balance sheet. And the ROA is calculated by taking the net income and dividing it by the average assets for the period for which you're looking for the return on assets. So let's say you're looking for an annual return on assets, annual ROA. So you look at what your assets were on your balance sheet at the start of the year, and then at the end of the year, take an average of that, and that number, you take your net income for that year and divide it by the average assets. And that'll give you your ROA. Now, once you've calculated the ROA, you have to figure out, well, what does this mean? Is this a good ROA or is this a bad ROA? It's not good enough. Well, you have to balance that by looking at what is happening in your industry and also what kind of business you're in. So manufacturing businesses usually have a lower ROA compared to service businesses. And again, service businesses, there are all kinds of service businesses. Somebody is providing internet services, providing media-related services, advertising. That's a service business. But then again, there might be other service businesses, utilities. Utilities have a very high investment in assets. If I'm in the business, if I'm NStar or Eversource, I have a lot of money tied up in fixed assets. So the return on assets is different for the industry and the business and the product. Those are the three profitability ratios that you should think about. Any questions on profitability ratios?
I don't believe so. As I think you answered the service part of the ROA after the question was submitted. So if he didn't answer it, please let me know. I do have another one. For gross profit margin, what is the difference between what has she got? ALES and revenue?
Sorry?
I'm not sure. I think we got a typo here.
Okay.
Sales. Here we go. There's the correction. For gross profit margin, what is the difference between sales and revenue?
You could have sales not just from your products or services. You might have some other additional revenues coming in. But generally, it's there for a regular business, there's the same thing.
All right, that's all the questions I have for that one.
Okay, and the last group of ratios. So we did 2 liquidity ratios. We did 2 operating ratios, 3 profitability ratios, and now I'm going to go to 2 working capital ratios. Working capital ratios are important to understand how are you managing the assets. And bankers and people who extend loans to you would be interested when they look at your balance sheet. They calculate these out. These are very quick calculations. The first one is, what is your gross working capital? Very simply, take your current assets, subtract your current liabilities. That's your gross working capital. And what is this telling you? This says the more you have, the less you will have to borrow when you need cash to manage your business. Clearly, when people look at that, the more you have, the less you want to borrow. But that's when more people are anxious to lend you money because they say, oh, this is a good business, they're profitable. So it's kind of, 6 of one, half a dozen the other. But gross working capital, you should understand your gross working capital. Again, you should look at the trend. If your gross working capital at a point in time is X, and in a subsequent point in time it's X minus Y, it's less. So wait a minute, what's going on over here? You should figure out what's going on before you reach a point where you say, oh, I have to go and I have to get more money from somebody. And the second working capital, so the first one, is not really a ratio. It's just one number minus another number. The second one is debt to net worth. And That is calculated also from numbers from your balance sheet. You look at your total liabilities on your balance sheet and divide it by the shareholders' equity. So on a balance sheet, there are two sides on a balance sheet. There's the assets on one side, and on the other side is the liabilities and your net worth, your shareholders' equity. The two always balance each other out, which is why it's called a balance sheet. But if you just look at the liabilities and shareholders' equity and divide one by the other, you would get your debt ratio. And if your debt ratio, you should try to make sure it's either less than 1 or less than 1.5, and that's fine. If it is higher, that says you are relying a lot on borrowing in order to run your business, as opposed to uh, internally generated funds that the business is generating in order to make it run and to grow. So, there's no right answer to this. I mean, you might be borrowing money because you're expanding and growing, but you just need to keep an eye on your debt to equity ratio. Those are the two working capital ratios. And any questions on working capital ratios?
Actually, I have a question on the profitability ratio
Okay.
that we missed. Do donations count if you're a nonprofit? For
Uh, I should make a separate note for this, Teresa. Anyone who is running a nonprofit, um, you're not going to be calculating profitability ratios. However, I always tell people a business is a business, whether you're for profit or not for profit. You do need to make sure the money that is coming in is more than the money that's going out. Now, for a nonprofit, the money that's going out is the expenses that are used to run the nonprofit. The money that's coming in is either a service stream of services that the nonprofit gets and donations and grants. So, a long-winded answer, you may not call it a profitability ratio, but yes, you should include all the money that's coming in, all the inflow, which includes donations.
I have another question for you, Ramesh, and then I also have a question after that for the Middlesex Bank folks so that they can get ready. Ramesh, how does a negative equity affect the debt to net worth ratio?
Um, the calculation that you will do will make it less than 1. So how does it affect? Basically, you are underwater. Your business is underwater when it's negative. You need to figure out how you convert it into to a positive number. So I don't know if that's a answer is good enough for you, but that's all what it's going to tell you.
All right, I'm sorry.
Yeah, sorry.
Here's my Middlesex Bank question. Regarding the bullet point comment on debt to net worth being too high, if SBA loans can be for 80%, sometimes even 90% to acquire a business, then the debt to net worth will be high. Is this where looking at debt service coverage ratio would be more informative?
I could field that one, Teresa. I'll take that in reverse. I think we always start primarily with the debt service coverage, in terms of the ability to repay any loan. But yes, if you're acquiring a business, and in other circumstances, debt to worth or sometimes loan to cost or loan to value can be high. And that's where you would look at an SBA type loan or SBA type enhancement to, guard against that higher debt to worth ratio. But generally speaking, we're starting with debt service coverage. We're looking at any financing opportunity or any business.
Okay, I have another bank question. What level of working capital do you look for when considering lending to a business?
I think the level is always comparable to the size of the business and the size of the loan. You know, it's sort of all relative. I think Ramesh was speaking to the current and quick ratios. I think that's what we'd look to more pertinently. We would look at, you know, current ratios being hopefully north of 1 times, hopefully north of 1 times, being a healthy current ratio when we're looking at a business's, you know, current position on their balance sheet.
I think this is a Ramesh question. For gross profit margin, are all costs included in cost of goods sold?
Uh, no, costs of goods sold only includes costs that go into your valuation of your inventory. In addition to that, all businesses have what is called SG&A, selling and general administrative expenses. So selling expenses, marketing expenses, and corporate overhead expenses don't go into the cost of goods sold. They're on your P&L. They will be indicated accordingly. You know, they'll have that in the description.
I think that caught us up on questions.
Okay, so my last slide is not something that I've had before. I thought I'll put it in. Usually get this question. Well, how do I find out what should it be? I mean, you know, because the competition is not going to let you know, you know, especially if it is not a publicly traded company. That's all private information. So I've given you some URLs. You can go to City University of New York. I found that they have a good guide on company ratios. So you can look at that, or also look at GSU. They will also, that research link, and then Suffolk University and the library guide also has things. So you can look at what are good financial ratios, either by industry or by area, and then you can do your calculation and then do a comparison. So, and that's all what I have by way of a presentation. But I'm happy to, and you know, Teresa you can go onto our website and ask for, you know, to set up time with me if you want me to discuss something with you. There was a question from someone, sorry.
Yeah, so they're asking about the slides, and yes, we'll be following up with the slides, and there is the recording that will be posted, and I'm gonna post that in a moment. Because yes, you wouldn't be able to get all those URLs down, so we will make sure everyone gets that. Let me see, I want to read this one first because I'm not sure if it's really business specific. Yeah, so we just had an anonymous submission about a HELIC loan. You know, it really probably would be more beneficial to you to reach out to a SCORE mentor so that they can sit down with you one-on-one and go over that with you. I think that would be your best bet. So definitely reach out for a mentor and they can go over that information with you. Ramesh, do you want to paste those links into chat, or we will definitely be emailing it out to everyone with the follow-up if that will work for everyone.
Hold on.
Okay.
I had to just move from the, you know, presentation to my slides. So I will do that. Oops. Did it come through? Actually,
Yep.
oh yeah, they did.
Let me answer this one. Apologize. They have to. I cannot type and read questions at the same time. Understand also. Okay, we did that one. Yes, this will be added to the recorded presentations page. And what advice can Ramesh give to new accounting students in college? How to learn how to gain practice of using these ratios for analyzing investments and thoroughly understanding the process?
Well, I would say I would suggest you look at the balance sheet and income statement for, just take a few of the publicly traded large companies or even medium-sized small companies and pick them for the same industry and across industries and, just see what it says and that should be able to allow you to do some practice.
All right. I think we've hit them all. And certainly if we missed any of your questions, please feel free to email me directly and I can connect you to Ramesh. You can also get a score mentor, and I'm putting my email into the comments, but it'll also be in the follow-up email as well on how to reach out to us as well. So we'll get you the URLs, we'll give you the how to get a mentor, we will give you the recordings, we will give you the contacts for the Middlesex Bank. So slides, all that will come in the follow-up email. Just give us a couple days to get that out to everyone. Okay. Thank you, David and Jeff. Thank you, Middlesex Bank, for sponsoring this important topic. Thanks, Ramesh, for a great presentation. And I hope you all have a great rest of your day.
Thank you, Teresa. Thanks, David.